Good morning, ladies and gentlemen, dear guests. It is an honor and pleasure for me to welcome you at the Czech National Bank. I do it on behalf of both the Czech National Bank and its board and on behalf of the Czech Economic Society. I am very impressed that so many of you decided to join us to listen and then to discuss a very interesting and important topic for central bankers. The topic is inflation expectations, how they are formed, how do we understand them, and also how they depend on communication. Those of you who follow the debates on our Czech monetary policy understand that this question, namely, how do we understand inflation expectations, play also a central part in our discussions. Many of us, including myself, put a lot of emphasis on inflation expectations, as I'm of the view that they play a key role in the consumption-saving decisions of households, for price setting of companies, and for the wage-setting processes. At the same time, we also know that we have many uncertainties about how these expectations are formed, that expectations by various groups of economic agents might differ, etc., etc. We will discuss these important issues with our guest, Professor Michael Weber from the University of Chicago, who will give us a lecture on the topic Subjective Inflation Expectations and Monetary Policy Communication, the Role of Medium, Messenger, and Message. Michael joined Chicago Booth School of Business in 2014 as an assistant professor of finance and was promoted to associate professor in 2018. He is also a faculty research fellow at the National Bureau of Economic Research in the Monetary Economics and Asset Pricing Groups, research affiliate in the Monetary Economics and Fluctuations Program of CEPR, a member of the Macrofinance Society, a research professor at the IFO Institute, and a research affiliate at the CES-IFO Research Network. He is also academic consultant for the European Central Bank, the Federal Reserve Bank of Cleveland, and several other central banks. His research interests include asset pricing, macroeconomics, international finance, and household finance. He has published in leading economics and finance journals such as the American Economic Review, the Review of Economic Studies, the Review of Financial Studies, and the Journal of Financial Economics, and the most recent, the Journal of Economic Perspectives, the article which you mentioned also, which I just read yesterday, very good one. Michael is a visiting researcher at the Bureau of Labor Statistics, where he studies how the inability of firms to adjust output prices to macroeconomic shocks affects their systematic risk. Michael was awarded for his academic work by many awards. I counted that there are at least 10 of them. I hope, Michael, that you will forgive me if I don't go through all of them, because it would take me at least 5 minutes, and I'm sure I would pronounce them with many mistakes. Michael earned his PhD and Masters of Science both in finance from the Haas School of Business at the University of California, Berkeley. He also holds a Diplom für Betriebswirtschaftslehre, Diploma in Business Economics with distinction from the University of Mannheim, which earned him the SEW Eurodrive Dissertation Award. So I mentioned at least one of them. We met with Michael in July this year at Dubrovnik at the economic conference, which is annually organized by the National Bank of Croatia. Already there, Michael impressed me with his presentation on a similar topic. Both the substance and also the way Michael is able to explain his research I found excellent, and I hope, Michael, that your outstanding performance from Dubrovnik will be repeated now at the premises of the Czech National Bank. So, Michael, thank you very much for coming, and the floor is yours.
Okay, well, thank you so much, Marek, for the way too kind introduction. I'm happy that you didn't go through everything you had written down. And to all of you for coming today and for bearing with me to tell you a little bit about some of the work we've been doing over the last couple of years to trying to understand how people form inflation expectations, to which extent they matter in our consumption savings decisions, some of the determinants of how people form expectations, but then also like how central banks potentially through communication and which type of communication potentially could shape and influence inflation expectations. And let's like, plan maybe for the next 1 hour or so, and please feel free in case you have some clarifying questions on the way to just directly interrupt me, and then we can maybe take it from there, and we have some time at the end for Q&A. Now, of course, Marek put the pressure high, so I hope obviously I don't disappoint you. So like, let's see. So like, okay, here we are, perfect. Okay, so now, I think given the current macroeconomic environment, I don't have to kind of convince this audience why it might be important to study inflation expectations, but here I just put up a quote by Chairman Jay Powell from last year, where he actually explicitly states, like, ultimately, they're terribly important, and we spend a lot, we as the Federal Reserve Board in the US, they spend a lot of time watching them. Now you could say, like, why would anyone care about inflation expectations? At least based on theory, obviously, they are indeed terribly important. If you take the core of any forward-looking economic model, what's at the core of that, of household decision-making, is the so-called consumer-Euler equation. What does the consumer-Euler equation tell us? Well, at the end of the day, I intertemporally allocate my savings consumption decision as a function of the real interest rate. Now, where does the real interest rate come from? If you take a subjective version of the so-called Fisher equation, that's here on the top of the slide, if we all face the same policy rates, but for whichever reason we differ in what we expect will happen to inflation going forward, we differ in our perception of the real interest rates, and because of that, based on economic theory, we should differ in how we intertemporally allocate consumption. Now, of course, like, this is all nice and good, and like for a long history going back to like the 70s, after the rational expectations revolution, we just took it for granted that this is how people make decisions. And famously, Ed Prescott, who tragically passed away like a few weeks ago in the 80s, said, like, don't show me any data. If the data doesn't adhere to my RBC model, the data must be wrong. Now, of course, that's something you cannot do anymore nowadays. And so, like, if you look at the data, you actually do see in microdata that indeed, like, if people expect higher inflation in the cross-section, they indeed are more likely to purchase goods. I'll show you a little bit of evidence on that. We have now evidence that people also decide of whether they take on leverage and which type of mortgages they would take depends on individuals' inflation expectations. But even like things like stock market participation and risky asset choice ultimately depend on inflation expectations. Now, of course, the topic we all actually kind of wonder and worry about right now, is it the case that when people expect high inflation going forward, that they really actually go out and bargain for higher wages, and there's potentially the concern for wage price spirals. So there's actually here in this domain, the academic research is still lagging a little bit behind, but for example, if you go to the Atlanta Fed wage tracker and you look at like the average realized wage increases in the US, on average, we are at the level of inflation right now, and if you're willing to switch your jobs, you see actually job switchers in the US have a higher nominal income growth relative to kind of the rate of inflation, and so like at least suggesting that people indeed actually would bargain for higher wages because of higher inflation. And then, of course, like, given that we are here at the central bank, what is kind of a conventional policy narrative? Like, in normal times, we typically assume that inflation expectations are well anchored. So therefore, like, when we actually play around with our nominal policy rates, that means actually if inflation expectations don't move, this leads to a move in real interest rates, and then potentially all of those bullet points we have here on the slide could be operative. But of course, we first have to understand whether inflation expectations are well anchored. So we come to that in a second. And then, here, for quite some time, until like maybe 2 years ago, we actually were worrying that, how could we still potentially stimulate aggregate demand if we are stuck in an effective lower bound? To the extent we can actually communicate and manage expectations, you can actually steer inflation expectations and increase aggregate demand. But of course, the same is true right now. To the extent we were able to kind of cool off inflation expectations, we would potentially cool off aggregate demand and potentially would have to raise interest rates by less than otherwise warranted to actually ultimately come back to some form of actually low and kind of close to an inflation target inflation rates. Now, what I want to show you first is like, the answer to the question, do people actually even understand what an inflation target is? So like what we did here in some work with the Korbio and Gorodnichenko in 2018, we asked 25,000 Americans, first explaining, following a few questions, we want to actually elicit your opinion of inflation. Inflation is the general increase in prices, typically measured by the consumer price index. What do you think is the rate of inflation the Federal Reserve, that is in charge of setting policy rates in the US, tries to achieve over longer periods of time? And you do see like, there's a fraction of households, maybe 20%, that do have kind of an idea what an inflation target is. What you also see, there's about 40% of those 25,000 Americans that, at least based on observables, are as representative as it gets, that answer the number that we just bunched together here in a single bar, larger than 10%. When we did the survey in 2018, the last time we had those inflation rates was like in the early 80s, so clearly like something that seems to be kind of quite off. Now the question then is like, can we learn anything from household expectations, or is it just noise? That's often a criticism. You ask people in surveys that just tell you something, it's not meaningful to begin with. What I show you later on, what we actually show in this paper, which was published in June in the Journal of Political Economy, is actually if you are able as a central bank to shift these expectations, and we do that through survey experiments, where we then can use our information treatments to actually get exogenous variation in inflation expectations, you are indeed able to shift their intertemporal consumption savings decision. So like, unconditionally, in day-to-day, this was a time period when inflation was low and stable, most people, they don't even know who the governor of the central bank is. Because in our day-to-day decisions, like inflation is low and stable, we don't worry about kind of those things at all. But of course, on the flip side, this means that if you're in times like now where inflation is high, if central banks don't find ways to directly communicate to households, you have a hard time to actually get inflation expectations of households in check again, to ultimately then potentially steer off kind of aggregate demand through actually lowering inflation expectations. The second thing why I don't think that inflation expectations are pure noise is because like there are systematic patterns in the cross-section of people. And so like, you do see, for example, if you split by income, if you split by education and things like that, there are huge differences that systematically relate to inflation expectations. The first such difference I want to show you here. This actually goes back to a paper in the American Economic Review in '82 by Jonung, who showed for Swedish households that households in Sweden had actually on average like upward bias inflation expectations. That's also what you see here. This is from data from the New York Fed Survey of Consumer Expectations between 2013 and 2018, realized inflation around 2%. On average, households clearly expect inflation that is way higher than what was ultimately materialized. But what you also see is that women have higher inflation expectations than men. So everyone has an upward bias, but it's even larger for women than for men. And while there are potentially important differences across men and women, it's unclear why inflation expectations should be systematically related to gender. And then that's what we actually try to investigate in our own work, where we fielded our own survey on what is called the Nielsen Home Scan Panel. And I'll tell you more about this data set in a little bit. The nice feature of this panel for the purpose of this paper was that we could actually survey from the same household female and male household heads. So allowing us to keep constant lots of things that potentially might vary across households and could be correlated with inflation expectations, family structure, whether you own or rent, mortgages, and all of those things. They are kept constant in this setting here. And then what we plot here is just within household, the average female household head versus male household head inflation expectations, single shot wave in June of 2015. You also see within household, the female household head on average expect about a 0.4 percentage point higher inflation rate over the next 12 months relative to the male household head. That's the left bar here. The only thing we do in the right two bars is we just look at our sample in the survey and we separate households based on the simple survey question, who in your household is in charge of grocery making? I do all the groceries, I do go shopping once in a while, I never go grocery shopping. And what you see is like in the middle bar here, that's like what we call traditional households, where the male household head declares to never go grocery shopping. The gender difference in inflation expectations is elevated and larger by about 40%, versus actually in the far right bar, that's actually households where the male household head declares at least once in a while to participate in grocery chores. And there you see there's no difference in average expected inflation across the female and male household heads, because also the male household head has higher inflation expectations. So on average, no difference. But then the question is, why is it the case that kind of like being exposed to grocery prices leads to this upward bias in inflation expectations? Now, one of the key reasons why central bankers would typically focus on like core inflation, stripping off gas, energy, and food, is because those price changes, of course, tend to be very, very volatile, quickly mean reverting, very little predictive power for future inflationary pressure. But maybe those are the very price changes households focus on. So let's actually try to get an idea. And so the first thing we did here in this overview paper in the Journal of Economic Perspectives that Marek was referring to, we just actually, in our own surveys, we relate what people perceive that inflation was over the last 12 months with what they expect inflation to be over the next 12 months. There's just a bin scatter plot, perceived inflation on the x-axis, expected inflation on the y-axis, and you see there's actually a very tight connection with what people perceive and what they expect. So therefore, to kind of understand how people form expectations, we have to figure out what the price signals are people actually use to form their perception of current inflation. And that's kind of what we did in another paper in the JPE with Francesco Da Cunto, Ulrike Malmenier, and Juan Ospina, who's now the head of research at the Colombian Central Bank. And so we just simply asked them in a survey, we asked you earlier about what you think inflation will be. There are different sources of information people could potentially use for kind of forming inflation expectations. What were the 3 most important sources for you? And then the potential answer possibilities, that's what you see here on the x-axis, they were provided in a randomized fashion just to make sure there's no anchoring because the first answer everyone ticks or so. The most important one, we then gave a kind of a rank or a number 3, second most important one 2, third most important one 1. And what you see here is like, at least within like this were 50,000 households in the US in 2015, by far the most important source of information as stated by these households was their own grocery experiences. Official news releases, TV, newspaper, and so on, certainly mentioned by a few people, but not nearly as possible, and not nearly as important. And so just to get an idea whether indeed our own shopping experience matters for how people form inflation expectations, we went to this Nielsen home scan data, and here I start telling you a little bit more, and I show you some more detailed statistics on this data in a few slides, where you can actually observe at any point in time for about 70,000 households what they actually purchased, where they purchased it, at which price, did they use a coupon, was it on sale, and so on. Because like anything that has a barcode, okay, unfortunately we have no, here it is. It's like anything that's a barcode and is purchased by households, those households have an optical scanner, as we know from the supermarket, at home, and then they would just scan whatever they purchased. So like from that data, you then know what they actually purchased and the prices. So what you can do then is go and do like what, in the US, the Bureau of Labor Statistics would do. At the household level, you define a consumption bundle. In our case, the first survey wave was in June of 2015, so therefore we said from June of 2013 till May of 2014, at the individual household level, what did that household consume? Let's fix that bundle. Then over the next 12 months, from June of 2014 till May of 2015, we observe the prices they paid. And then we can do what statistical agencies do, construct realized inflation, but not for a representative consumer basket, but at the individual household level. And crucial is also taking into account prices people pay, because there's lots of variation. Whether you go shopping at, let's say Rewe versus Penny, makes a huge difference, actually. And then what you see here, so here just first, I see, so sorry, I saw Kaufland, what is a higher price supermarket? I saw Penny, which I would maybe think is a bit cheaper. So in the US, it would be Whole Foods versus Aldi. I don't know whether you know Whole Foods. So like anyway, so like it really depends of where you go shopping. And so like, all I want to show you here, the far left bar here, this is 1/8 of households that in the past 12 months had the lowest realized inflation rate at their own bundle. To the far right from you, that's the 1/8 of household with the highest realized inflation in their own bundle. If you then actually collapse the data based on like, what do you think is inflation over the next 12 months for the overall US, people extrapolate extensively from their own realized inflation to overall inflation expectations. You see a difference of around 0.5 percentage points. You also see the generic upward bias, but actually still people extrapolate from their own bundle to overall inflation expectations. Now you could say, well, maybe they're just forecasting their own personal household level inflation. If you would actually, because we observed that, if you would plot that on the y-axis, are people that had high personally realized inflation in the last 12 months more likely to have high future realized inflation than households with low realized inflation? The answer is no. It would actually be a flat line, which is exactly the reason why central banks typically don't focus on groceries, because these price changes are quickly mean reverting. Nevertheless, it seems to be households are exactly using these price signals to form their inflation expectations. Something you don't see here in this slide, of course, then is something else we document in the paper. If we now actually dig a little bit deeper, you see that not all price changes, even within my own personal shopping bundle, are kind of created equally. People weigh way more stuff they purchase frequently. So if you weigh price changes by frequency of purchase instead of expenditure share, has a way stronger explanatory power, and they tend to overweigh price increases relative to price cuts. Now imagine central banks, we would be super, super effective, and let's say inflation would be back at 2% next year. It would still, based on these findings at least, suggest that it would take a considerable amount of time until expectations come back down again, because people focus way less on price cuts relative to price increases. Okay, so not only are not all price changes created equally, there are actually even specific peculiar goods that kind of work or kind of are relevant as anchor products for people to think about inflation. At some point, we just asked them, earlier you mentioned that's what you expect for inflation. Was there actually a specific good that came to mind when you actually answered this number? And so here you just see the individual answers and their frequency, and so you see in the sample here, milk was mentioned very often, the price of gas, and then daily products, bread, eggs, and so on, with a few kind of differences across genders as well. Now, of course, we do know on average gas prices are really important for the average level of expectations. They're not so important for the cross-sectional dispersion, but at least in the US, if you look at it, there's lots of differences in the level of the gas price. California, way higher gas price than somewhere in, I don't know, I guess they call it flyover country. So somewhere, I don't know, in Idaho, where the price is maybe half as high as in California. But once you actually look at the price changes, they are super, super strongly correlated. So it can help explain us the level of expectations, but not so much the dispersion, which is actually huge. So for expectations of, if you want to understand the cross-sectional dispersion, which of course then ultimately matters for how people differ in their consumption savings choices, you have to understand potentially how these price signals matter. So in the US, we focus on the price of milk. In Germany, it's the price of Weissbier. There's actually a Weissbier index. In Italy, it's the price of the café, the espresso. once it hit the €1 mark, this was a big scandal. In France, it's the price of the baguette. I don't know, maybe here it's the price of the boudoir. I have no idea, you know that better than I do. And so what we then did in January of this year, we actually tried to understand, is it then really the case that price changes of individual goods could actually shape how people think inflation will move going forward? And so what we did, we just said, well, look, I want you to think about now the type of milk you typically purchase, in the volume you typically purchase it, and at the supermarket where you typically purchase it. What is the price of that milk right now? And what do you think the price of that milk was 12 months ago? Now you might wonder, why do you actually ask a question in such a weird way? The reason for that is because we do observe what they paid in January, and we do observe what they paid a year ago. So what we can then do first is actually kind of compare what people think they paid versus what they actually paid, and then see like also, is now the perceived rate of increase of milk prices associated with what they think will happen to overall inflation. That's kind of what you see here. You know, people that perceive that milk prices increased a lot, they on average have way higher inflation expectations for overall CPI inflation relative to people that have a low perceived milk price. Then of course the question is like, do they even understand and have a good idea of what kind of like the milk price was? What you see in the data, they know very well what the current milk price is. So on average, there's no bias whatsoever. If you, however, compare what they paid a year ago and what they thought they paid a year ago, there's a systematic downward bias. So people think the price of milk was lower than it actually was. So they have an upward bias in the perception of past milk price changes, which of course, if I now use my perceived milk price change to form inflation expectations overall, this upward bias could help us understand why we have an upward bias in the average expected rate of inflation going forward. Now, of course, if you now say, well, what are the implications for central banks? Obviously, I'm not suggesting that central banks should target the price of milk, but maybe like, you know, helping understand people that inflation is not just a simple movement in a single price. What inflation is, that it's actually like there are components, like take the price of an iPhone. Obviously, like the actual sticker price maybe has been constant for a long time, but of course an iPhone now is very different than an iPhone 15 years ago. So like, you know, that there are quality improvements that effectively are tantamount to price cuts, stuff like that. Educating people is obviously important. And so like the only thing I wanted to mention in this example here, so like I remember very vividly, like when the euro as a paper currency was introduced in Germany, you know, there was this big debate like euro equals teuro being game of words for expensive. And so like, you know, my parents still claim nowadays when the euro was introduced that restaurant prices doubled. Realized inflation in Germany back then was below 2%. Nevertheless, people still have this idea that, you know, there were this huge increases in prices because they have this idea things were always cheaper in the past. But instead of like mentioning a price of milk from a year ago, they mention or recall the price of milk from 2-3 years ago. Of course, with trend inflation, this then just means that we have this systematically downward biased perception of past prices, which is then material for overall inflation expectations. Okay, so like, let's move on. So like later on, I want to argue that it's really crucial to actually come up with simple messages that are equally and transparent and simple to be understood by everyone. Why do I say that? So like, you might be familiar that in some of our Nordic neighbors, you can pretty much observe and merge whatever you want to observe about the individual. So here in this case, together with the co-authors, we actually cooperated with the Finnish central bank and were able to obtain for all men in Finland to get like measures from the military on a proxy for cognitive abilities that for simplicity I label IQ. That's like at around the age of 19, when actually you have mandatory military service, because there was always like a concern that Russia might invade again. You had actually do this cognitive test, and actually there were incentives to do well, because if you are like in the top percentiles of your cohort, you were able to actually participate in officer training. You don't know your score. You can, however, put on your CV that you were offered officer training, which of course then potentially has signaling value in the labor market. Then at the individual level, we were able to merge in from the European Commission, the consumer survey. So we were able to observe, what do you think is inflation over the next 12 months? From income statistics, we know their individual taxable income, we know their asset holdings, debt balances, and so on. So you can completely partial anything out you want to partial out, and then just look at the mean absolute forecast error for inflation for the next 12 months. You see, what do you think is inflation over the next 12 months? After 12 months, you see the realization. You take the difference between the two, take the absolute value, and then we just simply collapse or take the average by bins of IQ. And the way to read this data here, like in a given cohort, if you're in the bottom 4% of your cohort in this test, you get a score of 1. If you're in the top 4%, you get a score of 9. And then it follows a STAN9, a standardized 9 distribution. So most of the mass is somewhere between 4, 5, and 6. And so what you see here, there's this monotonic association that if you're on the bottom in your cohort in the IQ distribution, you have a way larger mean absolute forecast error for inflation relative to people in the top of the IQ distribution. In this paper, we then also show it's like, if you are anywhere like between 5 and 9, you behave like a textbook economic agent. You nicely substitute intertemporally, you do understand what inflation is, you form expectations in a more meaningful way. Instead, like, the bottom down here, they are more, and they're not financially constrained. Think, remember we are in Finland, I don't know whether that's appropriate. So I would call it almost like a socialist country. Very little dispersion in income. There's actually a super strong social security system in place. No one in Finland is financially constrained. If they wanted to, they could all substitute intertemporally. Like, technically speaking, they should all be on their Euler equation. Nevertheless, there's a big chunk of the population that doesn't react. Now, of course, what does it mean then for policy? If we now would actually implement policy, maybe informed by a textbook model, and we think that everyone reacts, but there's a part of the population that does react, and a part of the population that doesn't react, of course, you might then be concerned about redistribution from the bottom part of the IQ distribution to the top part, because at the end, someone maybe has to pay for policy. And so in this, in a follow-up work that we label human frictions, for example, we can show they implemented in 2015 a cash for clunkers policy. Trade in your old car, get 2,500 euros to buy a new car. Who actually takes advantage? Again, the top of the distribution by IQ, the bottom doesn't react, even though you actually see that the propensity to participate is actually, if anything, slightly higher at the bottom part, because like they have, on average, like older cars. And again, we can condition on financial constraints and all of that. So like, it seems like if you don't engage in policies that are simple, easy to understand and to implement, and you don't communicate clearly, you might be concerned of regressive and redistributive effects. And here is now just from some German data paper. We've used this just to show you that ultimately it really kind of makes a difference of whether people understand your policy. What we plot here is just some raw data. Of course, in the paper we are trying to be way more convincing in terms of doing econometrics and causality and stuff like that. But so like, this is just motivating evidence to kind of convey that policy complexity and simplicity potentially might play a role. So what do we see here? Again, European Commission survey data, this time for Germany. Top panel, inflation expectations. Bottom panel, durable propensities. Do you think now it's a good time to purchase larger ticket items? In the left panel, we focus on what we call unconventional fiscal policy. In the right panel, on forward guidance. Now, theoretically, at least through the lens of a new Keynesian model, both policies operate exactly identically. The left policy, however, this is like the announcement by former Chancellor Merkel when she was elected the first time in November of 2005. She announced that, in 14 months' time, January of 2007, will increase value-added taxes from 16 to 19%. Very clear, my dad understands, before taxes go up and my car will be more expensive in January of 2007, I should go out and purchase maybe a new car. In the right panel, these were the first two explicit announcements of forward guidance by former President Mario Draghi in July of 2013, where he said like interest rates, all key interest rates stay at current or lower levels for an extended period of time. And then in January of 2014, he firmly reiterated exactly the same. And then, like, again, my dad, at least according to the model, would actually understand that, they will keep interest rates low until after the end of a liquidity trap. Therefore, there will be inflation in the future. So therefore, today he already updates his inflation expectations and then goes out and purchases a car. And I'm pretty sure I lost some of you in the room. Clearly, Mario Draghi didn't reach my dad. And that's actually what you also see for Germans on average. In the left panel, if we actually understand prices will be higher in the future, people actually update their inflation expectations. They actually also said it's a good time to buy larger ticket items. You also see it in realized durable purchases. Instead, like in the right, neither on impact nor delayed, maybe because you could say, well, maybe he doesn't understand it, but then mortgage rates will be lower. He starts actually buying a house, or maybe car loans are lower. You don't see anything happening, neither on impact nor with the delay. So therefore, potentially, implementing simple policies that people understand could be important. That's kind of now what I want to show you in the remaining 30 minutes or so before we can start maybe entering a little bit of a discussion, just in a clean causal setting where I try to convince you that indeed message, messenger, and medium do actually matter. And to do so, I actually mainly will focus on this Nielsen home scan panel. And this Nielsen home scan panel, as we alluded to earlier already a little bit, think about there's a big chunk of Americans, and for all of these households, based on scanner data at home, you do observe what they purchase, and they do get incentives for scanning, so there's potentially very little measurement error in this data. And then at some point, what we started figuring out in 2015 is that we as researchers can pay Nielsen to run our own surveys on that very panel. So typically it's large consumer goods manufacturers like Coca-Cola that would actually, before they introduce a new variety of Coke, field a survey to get an idea is there even demand, is there concern of cannibalization, and so on. And then, however, we figured out we can do it ourselves. And so in this paper with Korbio and Gortnichenko, what we did in June, September, and December of 2018, we just actually ran our own survey. We designed the question, Nielsen coded it up for us, and then it was an online survey that was fielded on all participants on this panel. And the nice feature of that survey is that it's just so huge. The average response rate for us is around a quarter, so we have typically around 25,000 responses. If you compare that to standard surveys like the Michigan survey or the New York Fed survey, it's just an order of magnitude bigger, which of course then means for us as researchers, we can potentially do way more heterogeneity analysis, and crucially also do information treatments, multiple of which in the same wave, so therefore we can actually compare how different information might actually react to a different reaction across households within the same survey wave. Okay, so let me just tell you a little bit how we did that. So in June of 2018, we then actually fielded the first wave of the survey. We have about 30,000 responses at the across the different waves, 25 to 30 in the follow-up waves. So the key kind of course, object of interest for us was how do people form inflation expectations, and how do they use those inflation expectations for making subsequent purchasing decisions. And so what we then elicited, it was directly people's inflation expectations, because even there, and so in case you're interested, so this JEP paper Marek was mentioning, there are many pitfalls and subtleties how you elicit things. If you ask, in the Michigan survey of consumers, what do you think happens to prices? People tend to particularly focus on groceries and stuff like that. Instead, the New York Fed argues you should ask directly about inflation. So this of course also really depends and varies across kind of countries. So one really has to think carefully how one wants to elicit things. And then we also directly elicit point estimates. What do you think will happen in 1 year's time, but also probability distribution. So you can directly ask households to actually kind of add probability mass to pre-specified bins of potential future outcomes to then potentially also see whether the uncertainty of inflation is affected. And then of course, the key kind of way for us to kind of get at causality was then to provide in a randomized fashion to different households different information settings. So some of you might be familiar with this idea of RCTs, randomized controlled trials. This is kind of the same idea, but embedded within a survey. So you now elicit, what do you think will happen to inflation over the next 12 months? Then we just randomly split the whole room over here in different groups, and I just tell you different pieces of information. And then subsequently, you elicit again posterior inflation expectations. What you want to do here, typically you want to vary the question format a little bit, because of course a big concern is I ask you, I tell you something, I ask you exactly the same question twice. There's this concern of what we would call demand effects. You try to figure out, why do you actually ask me again? You just asked me, oh, well, you told me something. Do I react to that? So like, you want to actually elicit posterior expectations in a slightly different form. And so like, we do all of that in the paper, but let me now just tell you the type of different information treatments that we provided to those 25,000 households. So like the first set of treatments was just simple summary statistics, current inflation, the inflation target, and the inflation outlook by the Federal Reserve. Then we actually forced like 1/9 of our sample to actually, 1/8 in this case of our sample, to actually read an actual FOMC statement. Very dense, you potentially could get way more relevant information, conditionality and all of that, but crucially, all 3 summary statistics were also in that text. Then a subset had to read like a very short, simple kind of article in the USA Today of the most recent FOMC meeting, contained all 3 summary statistics, was written for a lay audience. And crucially, like already in the first 2 sentences, the summary statistics were in there, so there was no need to read this dense article, really. Then we wanted to see whether people have a kind of a Phillips curve in mind, so we told them the current unemployment numbers. We wanted to see whether people extrapolate from salient price changes to overall inflation. And then, like, a placebo treatment was just, the US population grew by 2% over the last 2 years. The reason for that, it's a number. It's almost the same as in many of the treatments, shouldn't directly impact inflation outlook, but we could be concerned there's maybe spurious learning, as we just said, like, I tell you a number, you react to it, so like, let's just see whether it's potentially relevant. And so like here in this setting, we wanted to understand, do people react to simple summary statistics, and then do they later on update their consumption savings choices, and then also a little bit like, is actually the source of the information relevant, a credible agency versus a newspaper? And so like, let me just directly tell you what we do econometrically, and I'll show you some numbers. So here effectively like, on impact and in follow-up waves of the survey, we just look at how do people update their inflation outlook. So like here, we have now at the individual level, after our information provision relative to before, what do you think is inflation? Then actually does this updating react as a function of the information treatment? And crucially, this is like a different diff setting, so we can look at the update of my inflation expectations in any of the treatment groups relative to a control group that doesn't receive any information. So now we want to understand, if I tell Marek a number, does he react? And I want to compare that to someone who doesn't receive an information to get, then actually, because like the message I sent to Marek is like exogenously provided, I can potentially interpret that causally. And then I can condition on a rich set of things that could potentially be relevant. And like, the 2 key things I want to highlight in this table, there are tons of numbers, but it's like, if you look, so ex ante, we saw that on average, people are biased upwards. You tell them some truthful information, they kind of update downwards the inflation expectations, what we want. But what you see is like the updating differs substantially across like whether they read a very dense, difficult, and hard to understand statement relative to the US Today statement, where people only react by half as much relative in a text that's written for a lay audience and stuff like that. And then, we try to understand, is it because in the cross-section of people there's if anything you see that, you could say, well, maybe people cannot even read and stuff. If anything, like this difference is even more pronounced within survey participants that have no high school and they are low-income earners. So within those, where you say, well, actually, maybe they don't even understand, they still react, so it's not that they cannot read and comprehend, it seems to be systematically related to the source of the information. And in fact, actually, what we show in that paper, where we ask, like, how do you rate different sources of information in terms of their credibility for news about the macroeconomy, what you see is that actually newspapers rank the lowest in the US, social media rank the highest, We might be concerned about that already based on what people, of course, then, potentially post and echo chambers and stuff like that. But then you could say, well, maybe it's USA Today. It's like shitty newspaper, it's not considered kind of credible. Then we actually asked them within newspapers, how do you rate Washington Post, New York Times, Wall Street Journal, Chicago Tribune, LA Times, and USA Today? Within those, actually USA Today was ranked higher than New York Times, Washington Post, and Wall Street Journal. They actually were considered way less credible. Chicago Tribune and LA Times were ranked slightly more credible, but they also had a way higher share of people that said, well, I have no idea, because they are way more localized newspapers. So like USA Today is not any less credible than any of the major newspapers, but it's just newspapers in general in the US that, of course, like is a highly polarized society. It's just actually not considered, newspapers in general are not considered a trustworthy source of information. So like even the source of information already matters. That's the first thing I wanted to highlight. Now, of course, we started out saying like consumption actually, we care about inflation expectations to the extent they affect actual decisions of households. Here it's actually a neat setting. On the one hand, potentially, we have exogenous variation induced by our treatments in people's inflation expectations, but then I can actually observe at the individual level what people actually do going forward because of this home scan data. So therefore, let's actually first show that what people actually state in surveys is not pure noise, but in fact actually lines up super, super well with what they actually do. So here, we actually asked them retrospectively over the last 3 months, how much did you spend on, and then we have a whole bunch of like 12 categories. We give examples, and this is just here for food, because food I can very well observe in the home scan panel. And then I compare like what people stated in the survey to what they actually did in the scanner data. And what you see here is like, there's this super tight connection between what people say in a survey with what they actually did in their day-to-day purchases. And therefore, we then actually kind of use both scanner data, but also survey data to then relate what they spent in the 3 months or 6 months after our initial information treatment. And we regress it on their inflation expectations, but we actually instrument their inflation expectations by our information treatment. So like we get actually an exogenous variation induced by our information provision. So here you can actually now, in a causal way, see how inflation expectations relate to actual consumption decisions in the next 3 months and the next 6 months. In the top panel, first in the survey, in the bottom panel, in actual scanner data. And what you see here is like those households that have higher inflation expectations induced by our treatments, they indeed actually go out and consume more. So like I think at least, I think this is kind of the cleanest evidence I've seen where you can causally see how people actually shift intertemporally their consumption savings decision in a causal way. Okay, so like the second thing I want to briefly actually mention, just to kind of make up for like the title. So like here we have the kind of the medium. Now I want to talk about the message a little bit. For that we actually go to Finland. You kind of already know the type of setup. So Finland, you can observe lots of things. So like here we want to now understand whether kind of keeping constant the sender of the message, which in our case was Olli Rehn, keeping constant the medium of the message, and just, Olli Rehn, the governor of the Bank of Finland, keeping constant the medium via which the message is sent. In this case, his official Twitter account, we want to vary the kind of context or the message and see whether kind of communicating about kind of our instruments of policy, like now we, in the current time, we increase interest rates a lot to potentially lower inflation, or like in the time at which we did the survey in June of 2020, we have like, a large-scale asset purchase program to hopefully kind of save the Eurozone, like whether kind of specifying the specific instrument via which you aim to achieve your ultimate targets is actually more effective, or potentially just like simple kind of like, what is even the target of my policy, but that's just, communicating, this is what I want to achieve. I'm constructively imprecise. I don't tell exactly the exact way how I want to achieve my target, but I just actually convey what I try to achieve. And so like there's some very nice theory work by Marius Angeletos and Sastry, where they effectively kind of theorize under which condition actually just communicating as a central bank, the aim of your policy might be way more effective in managing expectations of households that, as we just saw, potentially are indeed quite important for consumption savings decision, or whether actually we should directly communicate about the instrument. Now, let me just show you kind of what in our case, our attempt was to kind of study target versus instrument communication. This is now from the official Twitter account of Olli Rehn, tweets from the same time period in the Q1 of 2020. And so here, like, we didn't show the figure, but, we had just the text, where we have like as a target communication, the European Central Bank will do whatever is necessary to minimize the financial damage to citizens caused by the corona crisis. And so like this is from a discussion by Marius Angeletos and Jackson Hole of 2020, where we referred to communication like this as simple, crisp, and constructively imprecise. The second type of communication, again, Twitter account of Olli Rehn, this time, however, directly talking about a policy measure that was implemented to achieve, like the previous, no one actually has to suffer any harm, was the new 750 billion pandemic emergency program was launched by the ECB. Again, like, we just set the text as a treatment, no figure, no link or anything. And then, like, just to make sure, we have two treatment groups and a control group. Everyone has to read a little sentence to make sure everyone has the same cognitive load in the survey. Everyone has to actually think about some times of crisis. In the first two treatments about the corona pandemic, in the control condition, we actually referred to the winter war 80 years ago, also a tweet by Olli Rehn, also from Q1 of 2020. And again, like, no link or figure, just a simple text. And then the setup in this paper was like, we elicit like what people think will happen to their income in 2020 before. Then we show them those simple texts, and then we elicit again their income change expectations, but this time instead of average monthly, over a 12-month horizon. And then what we do, again, similar setup to earlier, we want to now understand how people update their income change expectations as a function of the tweet by Olli Rehn they saw. Treatment relative to control, target versus instrument. And like the first thing, in a simple qualitative manner after the information provision experiment, we just simply asked them, to which extent do you think that this policy you read about will benefit Finnish households? 7, I think it will benefit a lot. 1, I think it will benefit Finnish households only very little. What you see for the target communication, don't you worry, the whole distribution is shifted to the right. So even in a simple qualitative manner, people are way more confident if you tell them like, it's like, we actually take care of it, trust us, versus specifying the concrete policy via which you potentially aim to achieve exactly that target. And then like in a regression format, simply first target versus instrument for the overall population. You see like, target communication is already a little bit more powerful relative to instrument communication. But as we saw earlier, there's of course lots of heterogeneity. And if you then just do a simple split, top versus bottom of the distribution by cognitive abilities, you do see that for those in the bottom of the distribution by IQ, and this is only Finland, so I cannot generalize anything, it's only men, so like I only can talk about men in Finland that happen to be 18 between 82 and 2015, that's the data I have. For those men, at least I can state that, if you're in the bottom of the IQ distribution, you actually become way more optimistic about your personal income if you actually read the tweet by Olli Rehn that states like, don't you worry. Instead, if you read a tweet by Olli Rehn that just says like, we now launched a super big program of 750 billion, people actually don't react to that. So like, having like things we think, communication that's very precise and, maybe for financial markets it's crucial, but for ordinary households, they, don't react to jargon, so we have to find ways to communicate, as Angeletos says, simple, crisp, and maybe, kind of I don't know, constructively imprecise. So this was the second part. This was now the message. The last part I briefly want to kind of, at least, as a teaser, show you some basic results. Is from another paper with Andreas Fuster in Lausanne and Francesco D'Acunto, where we actually try to understand whether also the messenger matters, keeping constant the message and the medium. And so this is kind of to motivate what we do in this paper, from, I think, the first tweet after Christine Lagarde took the helm of the ECB. They went to kind of a retreat in the Taunus just outside of Frankfurt, where they then actually sat together and got to know each other, I guess, and chatted a little bit about the future of monetary policy and maybe what she wants to change. And I'm not on Twitter, but she posted this on Twitter, and what happened subsequently, colloquially, supposedly is referred to as a shitstorm. So they say, well, this is really just white men. Does this look like an open discussion? Très blanc, très vieux, très mal. It's over here, this is Christine Lagarde, in case you actually haven't even noticed that there's she's also here at the table. And so this at that time, also true in the US, true across central banks, member central banks of the European Monetary Union. It's typically it's a lot of white men together in a room, and so what we want to understand whether potentially there's kind of many good reasons why potentially you might care about diversity in policy making. You want to get rid of groupthink. You want to potentially also a legitimacy reason represent the population you serve. Those are all kind of quotes that have been made. What we, however, thought, there's nothing to this ethical debate. We as researchers with our background could contribute. But what we wanted to understand whether there's potentially also a communication angle and aspect. And so we asked through one of those survey experiments, is it the case that maybe women and Black Americans react differently to an identical message that is sent in an identical fashion if we make salient the representation of a female or a Black policymaker on the FOMC, the Federal Open Market Committee that is in charge of setting policy rates in the US. And we did that through a survey experiment. We had about 9,000 people. We did that in the summer of 2020, before the change in policy framework by Jackson Hole, and we wanted to understand to the extent there is potentially differential reaction, whether it's because of a different degree of trust subsequently, or potentially what we call an information acquisition or paying attention channel. And then also we document actually ex ante, there's just a very large differential degree of being informed about what the central bank is, who do you think is in charge of setting the basic level of interest rates in the US, CEO of big banks, the Treasury Secretary, Congress, or the Federal Reserve. Just basic questions to understand. And so what you see is ex-ante women and Black Americans are less informed. They also kind of have larger biases for inflation and unemployment expectations, which of course would all be consistent that they are maybe less interested because ultimately they see they're not represented potentially on this decision-making body. And so in the paper we actually then try to do way more tests to the extent we find any result. Pinning down the channel, is it what we would label homophily, meaning that I kind of associate more with someone that looks like me and that's why I react more? Or is it what we label taste for diversity? I'm generally potentially more interested if I see that there's also kind of people that are kind of relatively underrepresented of this body on as part of the decision-making process, and that's why I react more. And so we shed way more light. For today, I'm not talking about this at all. I just want to show you our simplistic maybe attempt to shedding some light on this question. And the way we do that, by now I guess you are familiar, information provision experiment in the survey, you elicit prior expectations, then you split the survey population in different groups. In this setting we had 1 control group and 6 treatment groups. We had 3 treatment groups that actually received forecast for the inflation rate for 2021 and 2022, I think, I think so. Anyways, you'll see it in a second. And then 3 groups that received the same forecast, but for the unemployment rate. And then 2 groups saw a picture by a white male policymaker, 2 groups by a white female policymaker, 2 groups by a Black male policymaker. All 3 regional Fed presidents, all 3 non-voting or alternate member on the FOMC, so they had all the same titles, the same role, and I show you our treatment screens in a second. The only difference was difference in race, difference in gender. Other than that, and we can discuss, like, of course, a few other things potentially could differ. A control group, just to, again, everyone has to read the text and sees a figure. Just actually saw this screen here where we just tell them what the FOMC is, how its composition is, and so on. And to increase the chance that people actually read the text, they were forced to stay on the screen for 20 seconds. Then, like 2/7 of our survey, like 2 treatment groups, saw a picture of this gentleman here, Thomas Barkin, who's the president and CEO of the Richmond Fed. And then 3 treatment groups saw the inflation forecast from the summary of economic projections that was passed in June of 2020. And by the way, here you see actually that they were also pretty bad forecasters for inflation. They thought that the inflation rate in 2021 on average would be 1.6%. 2 groups saw a picture of this gentleman here. This is Raphael Bostic, president and CEO of the Atlanta Fed. Again, you see like the inflation treatment. There was also a treatment screen where you had the same picture but unemployment forecast. And 2 groups saw a picture by Mary Daly. Again, a picture, and this time the unemployment treatments. Now, of course, they also differ in addition to race and gender, what they dress, whether they smile or not. So we actually did, check that in an auxiliary survey. What do you think is the job of this person? How trustworthy do you think this person is? Would you actually like to have a beer with that person? I'm making this up now, but like just give an idea. Are there other important differences across people? Across those pictures? Like, of course, the most important one was actually race and gender. What you saw, this is the only difference that was systematically significant across the different figures, that survey participants were way more likely to think that Mary Daly is a high school teacher and Barkin is a lawyer. No one thought any of the 3 is a public sector official. So like, there was no name recognition or anything. And then subsequently, as we said, we again elicit posterior expectations, and then, how the first outcome we also wanted to shed light on is to which extent do you actually trust the Federal Reserve to care about the well-being of all Americans, including people like yourself? This was the first trust question. The second trust question, to which extent do you trust the Fed to adequately manage inflation and the unemployment? And so here, I first want to show you, ex ante, there are systematic differences in the extent to which people trust the Fed. So like what I'm doing here is just simply split my survey, left panel, and actually like here we do it differently. So like in gray, it's like white male survey participants, in red, everyone else. So female and black survey participants. 7, I trust a lot. 1, I trust a little. What you see here, either like adequately manage inflation and unemployment, or like caring about the well-being of all Americans. There's a systematically higher level of trust for men relative to women and black survey respondents in the Fed. So that's ex ante. Now what we want to understand, does actually the share of survey participants that have a low level of trust, so 1, 2, 3, differ depending on who I see? Bostic, Barkin, Daly. Is it the case that maybe women and black survey respondents become less distrustful of the institution when they see like a diverse policymaker being part of that institution? And so like that's what you see here. So this is now the share of survey respondents that have a low level of trust. So like lower bars means higher level of trust. Like in the left panel for white respondents, in the right panel for black respondents, in dark gray for male respondents, and light gray for female respondents. Okay, what do we see? What you see here for white women, their share of distrust when they see a white male policymaker is 46%. It goes down by around 5 to 4 percentage points. It's significant in regressions when they see a female or black male policymaker, versus for white men, it's roughly equal. slightly higher maybe, but roughly equal. Instead, for black respondents, even stronger. What you see here, like black women, actually the share of distrust decreases by 7 percentage points if they see Mary Daly or Raphael Bostich relative to Thomas Barkin. And for black male respondents, the treatment effect is also between 8 and 9 percentage points. So like a significantly lower share of distrust when black survey respondents and women see a black male or a white female policymaker. And then in this paper, we also show that they are more likely to then incorporate the expectations that we provide, identical expectations, identical way of providing it in the survey, into their own forecasts for inflation and the unemployment rate, if actually the message is sent by Bostich or Daly relative to Barkin. So like potentially, like this was then the last part of the title, even the messenger could matter for the extent to which people incorporate identical messages in their own expectations. Like to wrap up now the talk, I want to just come back to some kind of current issues. Like, we discussed earlier, like, we typically assume that inflation expectations are well anchored. And now you could say, well, everything you showed me so far was for 12 months ahead expectations. But of course, like, I don't care about 12 months ahead expectations because they can, of course, move to temporary shocks, invasion in Ukraine and stuff like that. I care that long-run expectations are well anchored. And so therefore, like, they don't move. Short-run expectations can go up and down due to temporary shocks. Is it really the case? And so, like, what we are just showing here is like, revisions in 1 year ahead expectations versus revisions in 5 year ahead expectations for the same individual. And what you see here, if people update upwards their short-run expectations, they're also very likely to update upwards their long-run expectations. So a very strong co-movement for short-run and long-run expectations. So, like, this doesn't, of course, mean that, there's no hope at all to manage expectations, but simply assuming they are well anchored, I think that should be kind of out of discussion by now, and we should have to come up with ways to indeed make them well anchored, but we certainly can no longer assume they are well anchored. Then the second thing is, like, briefly want to show you a little bit of evidence how inflation moved in the pandemic and potentially differentially across households. This uses now the Nielsen home scan panel, where we look actually early on in the pandemic, what was quarter-on-quarter inflation. So to annualize those numbers, multiply it by 4. And what you see is, like, across the income distribution, like in normal times, there's very little heterogeneity, but what you saw earlier in the pandemic, a big gap opening up, almost like 3 percentage points annualized between low income and high income households. And the reason for that is, on the one hand, people differ in their consumption bundles. So we buy different stuff, they had different price movements. But of course also, like, as we discussed earlier, there's also, if you're a high income household, now, imagine like Rewe, Rewe by now, in a high price store. If you're a high-income household, you go shopping at Rewe, and then, like, the recession hits, and you go to Aldi, low-price store, so you can actually adjust the prices you pay. Instead, if you're already shopping at Aldi, you already purchase stuff on sale, and you already use coupons, you have no trading down mechanism, which also is, of course, relevant, and with, what we show here in the data. Then, we also saw early on in the pandemic, immediately inflation expectations. When people see higher prices in the supermarket, inflation expectations went up. And then again in the summer of last year, when indeed actually salient price changes saw a large increase. Now you could say, I still don't care about households, I only care about firms. They are the price setters in the economy, and to the extent they don't pass through input price increases into output prices, we don't see any inflation materializing. And, of course, we have on average way less evidence for firms, but the evidence we have so far is actually hinting that even firms are very similar in the type of patterns, how they form their own inflation expectations. Like for them, it's not the price of milk. For them, it's the price of their most important intermediate inputs. But, the very same kind of logic also applies to firms. It's not that, they necessarily listen all the time to the governor of the central bank and they have well-anchored expectations. No, also for them, the way they think about inflation dynamics is largely coming from what they see happening to their marginal costs in and intermediate input costs, wages, stuff like that. And so, like, If you are still here, you might be interested in these topics. Like we've written a couple of overview papers and that kind of cover all the type of stuff I try to squeeze in into an hour. If you're interested in that, and so like, let me just wrap up here. So like, based on like some of the work we've done, like on the one hand, I think we have to be aware that households and to a large extent also firms, they don't behaving like our textbook agents. They tend to focus on peculiar goods and forming overall inflation expectations. They actually tend to focus more on price increases relative to price cuts. So there's an asymmetry, and I try to convince you that also messaging is important, but I think the key challenge for central banks is actually finding creative ways and reaching people, because like I think this extensive margin is the most important one, because nowadays people don't actually read newspapers anymore, and if they do, they skip the part that it's about economics. And so like, maybe that's a bit far-fetched, but think about what the Central Bank of Jamaica has done. They recorded reggae songs with national reggae heroes singing about price stability, why high inflation is not good, why deflation is bad, but why stable prices is something we should actually aim for. The Federal Reserve Bank of Cleveland, they at some point recorded little videos with Lego people they put on YouTube, where they just actually had interactions of Lego people and saying like, what is the Federal Reserve, why actually they can potentially, with interest rate policy, control inflation, what the transmission mechanism is, like, finding ways, A, that make it actually interesting for people to actually get that information, and B, just actually educating people in general about inflation and monetary policy and stuff like that. I think that's ultimately, what I would hopefully see as a takeaway from this talk today. Thank you.
Michael, thank you very much for this very heavy, exhaustive presentation, but also very, very interesting. I just now wonder how to go about the process now, so we can start with questions. If not, I will start myself. I just wonder, there are, okay, so I don't want to monopolize it for myself, so please go ahead.
Okay, thank you. You argued that the inflation bias partly, or maybe mostly, comes from not remembering what the prices were in the past. Is it because of too rosy memories of the past, or is it because people just don't distinguish what was 1 year ago and 10 years ago, and maybe they just remember that, oh, well, milk used to cost 50 cents sometimes in the past and maybe not last year? And is there a similar effect with wages? Do people remember how much their wages increased over the past year?
No, excellent questions. Like this, I cannot fully disentangle as of now whether people have just a rosy memory. This idea, in the past everything was better, kind of. Like, if I talk to my grandma, that's kind of one of the sentiments she has. Like, versus it's just kind of a wrong recollection. I do think, however, it's certainly like a perception of what prices were in the past certainly plays a role. For example, this idea that, in Italy, you go anywhere and they tell you like, the price of the cafe has to be like 80 cents and now it's 120. So clearly we had like huge inflation because they have this anchor good and they have kind of an idea what the price should be, and they always make reference to that. And so like in this work with Francesco da Cunto that I was highlighting, we try to actually make sense of some of these stylized patterns in a kind of model of memory. So like mainly borrowing from literature and cognitive psychology, arguing that we cannot recall everything all the time, and there's a difference between short-term and long-term memory. And once we actually have to kind of draw signals from our long-term memory, we are subject to kind of biases. And then if you think now in a simplified way, you go shopping, you actually enter all of those signals in your memory database. The goods you purchase more frequently are a larger chunk of your memory database, so you're more likely to recall that. But now if you are asked to recall prices from a year ago, of course, you have many, many prices stored in your memory database from 2 years, 3 and 4 years ago. So like, just because of that, you're likely to potentially also remember a price that is longer ago. Now, this is of course like, a very kind of mechanical way of thinking about it, but at least there have been tons of lab experiments in cognitive psychology that seem to suggest that actually this is the way how people kind of form expectations. But I definitely think that this idea that, in the past everything was better also plays a role to some extent. And now coming to the wage setting part, I think there we actually have too little research so far, because I think largely in the, oftentimes research unfortunately is like US biased. And in the US, we haven't seen wage pressures now, given the low degree of unionizations for decades. It's only recently that, given the super tight labor market and the high inflation, that we actually did see wage increases again. That I'm aware of 2-3 teams of researchers studying it, but I haven't seen any evidence yet.
Thanks. So if I may, I would like to ask 2 questions. So first of all, welfare cost of inflation. So how what we have learned, thanks to you, about expectations now translate into understanding, modeling the welfare cost of inflation. So how to assess them now better. And the second point would be distinguishing between qualitative and quantitative expectations or perceptions.
Yeah.
Like what's your stand on that? Because in your financial review studies, you are making an argument maybe qualitative are even better than quantitative. That doesn't matter probably for EQ, right? So what is your takeaway there?
No, those are great questions. So let me maybe first start with the latter. So is it the case that if, in normal times when inflation is 2% and I say in a survey it's 10%, that I act as if I have 10% inflation expectations? Here the short answer is likely not. So because you don't see people going on a spending spree, which you would expect based on that answer in a survey. So what's crucial in kind of eliciting expectations, if you have a panel, you need kind of what's called an individual fixed effect. So if I now typically say 10%, but now next month I update upwards to 11%, I indeed am more likely to go out and buy more now. And so it's crucial, if you have a panel, you can elicit point estimates numerically. If you don't have a panel, actually if you only have repeated cross-section, you only see me once and not repeatedly, then actually what the European Commission does is actually a pretty good way of eliciting expectations, where you ask, what do you think will happen to inflation over the next 12 months relative to the previous 12 months, which is almost like within individual kind of variations. You don't know what the level is, but I expect higher inflation going forward now, and then theory would tell me I should now go out and purchase more, and that's kind of what you see indeed. So it really depends. Panel, I think quantitative expectations, you can elicit it, but you have to actually kind of look at deviations within individual. Repeated cross-sections, I think actually qualitative. At least you should also have qualitative expectations to get an idea of how people actually now consume. Now coming actually to the welfare cost of inflation, there are a couple of things. There has been this quite influential study by Aoki, from almost 20 years ago, that actually looked at, what is kind of the price index a central bank should target. And you have sticky price goods and you have flexible price goods. The key insight of his work was that actually as a central bank, you should target prices of sticky price sectors, which typically tend to be closer to consumer goods, and flexible price sectors tend to be more upstream. And the key assumption in his paper was that people have rational expectations. Now actually there's a job market candidate from Tübingen who's on the academic job market this year, who instead actually says, well, let's actually try to understand what are the prices people pay attention to. And we saw it today, it tends to be everyday goods. And in a setting like this, where consumers put a higher weight on groceries, the price of gas and stuff like that in the expectations formation, then actually at some point you actually get that it's welfare optimal for a central bank to target headline inflation, including kind of groceries, gas, energy and stuff like that. And now in terms of welfare cost of inflation, now there's been this work by Nakamura, Steinson and co-authors that actually documents that you would expect that in the standard model, it's price dispersion that's really, really costly, because the price signal, the relative prices are no longer informative if you have lots of price dispersion. Now, in our setting, if it's really the price of individual goods that are kind of relevant for how people form expectations and make decisions, then at some point, price dispersion loses its cost because like anyways, relative prices are not that informative. So like that's now me speculating on the spot. I think I have never thought about that before, but I think actually this would be kind of a cool thing to kind of think about more carefully and actually maybe even test that in the data. Thank you.
Jan Frey, Czech National Bank. Let us move to monetary policy. If I look at your conclusions or takeaways, I'm not sure whether I put it correctly, but people, the agents may place a lower weight on negative price changes, and expected inflation will not stay depressed if inflation comes up. So, and if we look back, last 20 years nearly, the central bankers and economists were obsessed by the fear of depressed inflationary expectations. In this respect, don't you think that, let us say, we oversolved the fear of low inflationary expectations leading to overly excessively, let's say, loosened monetary policies in the last 2 decades?
Yeah, no, that's an excellent question, and I think here it really depends on like whose expectations we look at. So like, certainly for financial market participants, you did see at some point there was a concern potentially they're systematically drifting down and that they potentially would expect like, large, even a concern of deflation. I think for households and firms, you never saw that. So like, they were always well above realized inflation. But again, so like going back to like one of the earlier questions, that then also depends a little bit that you have to look at changes within an individual. It might still be a concern that if I normally kind of expect 10% inflation, but now I think, well, actually going forward now it will only be 7%. Where if you just look at the level, it would look like indeed still there's no concern of like deflationary spirals. But if I now actually expect lower inflation going forward, and because of that, I would then postpone consumption, I indeed might put downward pressure on inflation. So like even despite the fact that average household expectations were still pretty high, there could still be a concern of deflationary spirals materializing. But I definitely think, as you said, like, there's also a good reason to think that maybe it was just partially at least overstated. Thank you.
Okay, I'm Evgen Kuchand. I'm with Charles University. Thank you for a nice presentation. I'm sorry, I came a little bit late, and I do not know whether you covered that in the beginning of your talk. But one of the takeaways is that message medium and sender matter. Is there a way in your research to account also for the treatment, how the news is treated? Because we have evidence that treatment is quite important, and how the media treat the central bank announcement is really crucial. And the negative tonality also matters quite a lot. Thank you.
Yeah, that's an excellent comment. As you say, like the tone of coverage is indeed relevant. So, like we ourselves haven't done work on that, but indeed there's actually strong and convincing evidence that also like the tone of a message really is important indeed. It's like, Yorgo-Nichenko has a recent paper in which they also argue like, even if we look at kind of facial expressions in press conferences of policymakers, that there's also actually contains information. Like just in general, I think, the message, the way it's kind of transmitted and kind of, all of those things potentially do matter indeed how people actually kind of react in their expectations to communication. Thank you.
Anyone else? Yes, please.
Short question. When you were talking about the silent goods, so you were mentioning like milk and gas, and that, and you argued that the expectation about these goods really matter for the consumption spending decisions and for the Euler equation. But with this good, it seems to me that they are very hard to, front load or intertemporally distribute. Actually, it's hard to consume a lot of milk today or store it for tomorrow. So if you could comment on that, thanks.
Yeah, no, totally. That's an excellent point. So, I'm not trying to argue that I form expectations based on milk to only intertemporally substitute milk. Instead, I actually inform my expectations based on what I perceived happened to milk for overall inflation. And then based on my consumer oil equation, I intertemporally shift my overall consumption and not only as you say, I'm not starting to drink 10 liters of milk because I expect high inflation, but instead actually I start consuming more because I expect higher prices going forward. Thank you.
So we have to go slowly to the end. So, Michael, I listened twice to you. Maybe I will now abuse a bit the role of the moderator. So, I asked you in Dubrovnik the question, what all that mean for central bankers as policymakers? And let's do the following. I will try to present my own takeaways, and you will tell me if I would pass the exam with you after listening twice to you. So, though we understand very little, I think, about inflation expectation, they do matter. Intertemporal substitution works. There's an upward bias in inflation expectations, which I think could have two consequences. One, mentioned by Jan Friday, maybe we overestimated the depressed inflation expectations in the last maybe 10 years. But on the other hand, I just ask myself if we don't underestimate the risks of it now in this environment of high and long-term inflation, and if we should not actually a bit overshoot with our monetary policy to bring inflation down. Then we understand that inflation expectations are endogenous. Media, message messenger all plays a role. In terms of message, you said that to communicate target is more important than to communicate instruments. But I just wonder, I think I understand the logic, but I just wonder if it's not very much dependent also on credibility. You can do it only if you are very credible, then people simply trust you, but if you don't have credibility, the thing would probably look different. And in terms of messenger, I understand it's better that the messengers are that the population finds itself in the messengers. Now we have, half of the Czech population are women. We have 2 women out of 7 members of our board or on our board. So maybe there is a bit of improvement in this direction. So at least on this part, I hope we are doing a bit better. So what about my points? Would it be okay with you or not?
I would give you an honorary MBA from Chicago with distinction.
Thank you very much. So is there any other question? If not, now we have time for lunch, which will be served in front of this room. Those of you who go on to the conference of the Czech Economic Society, you can make your registration. Where is it? The floor below us. You can use the lunch break also to get registered for the Vysoká škola ekonomická, so that you don't have to spend time over there. You can do it already here. So thank you very much for your attention, and Michal, all the best.